It's the new fund on the block, so popular nowadays that it threatens to edge out old school competitors. ETFs, exchange-traded funds, have become a money magnet. Of every $100 invested in the market now in 2008, $9 went into ETFs. That's more than quadruple the amount in 2001. Tonight we've got the 3 things you need to know about ETFs. Now let's talk about the 3 things that you need to know to make them work for you. First off, Steve, you say liquidity, the fact that you can touch it and feel it and get to it.
Yeah, I mean, liquidity is one of the 3 pillars of investment. You want to be able to get to your money, and I love Jennifer's point of view that, you know, during 1987 in October when people wanted to sell their stock funds, by the end of the day it was down 500 points. Yeah. You got the worst price at the end of the day. At least with ETFs you can get in and out all during the day. Not that you want to trade them, but just that liquidity factor is extremely important.
And to that point, it's kind of like democratizes the whole trading.
Yeah,
some people.
Well, you know, it just makes it very easy. Now, one of the downsides is that it's like a stock, so every time you trade it, you're going to be paying a commission on that. Now, if you go to a discount broker, it's one commission. You're doing it through your regular stockbroker, it's another. So those commissions can add up. So you want to be extremely careful with regards to doing a lot of trading.
Cost here, you got to really pay attention to cost and where it's coming from.
Well, these are what are called passive funds. You have active funds where you have got someone there actually making the trades. These are passive funds, and because of that, the fees are relatively lower. Some of the fees inside some of these ETFs are so low, it's really unbelievable, like 0.09%.
Oh, we like that.
Versus 1% or 1.5%. So that really increases your return. I think Jennifer's point about the taxes, though, we shouldn't underestimate that. At the end of the year, a mutual fund, whether you just bought it the day before or you bought it a month before, and if it distributes capital gains, you've got to pay those capital gains. With an ETF, they don't distribute capital gains, so you don't have to worry about that.
Okay, and Steve, you got
bonds
one too?
Are a new category, and bonds are a problem because they have a tendency to be a little bit illiquid, but in some of the ETFs, they're becoming more and more liquid. One of them is the LQD, which is an iShares fund of investment-grade bonds. It's a good thing to look at. It's still yielding over 6%. I own it. My clients own it as well.